Markets start the week with concerns around the US Fed's rate cut timing after June's stronger PMI on Friday. All eyes are on PCE data this Friday, and the yen is on the back foot, the US dollar rising through 159 last week. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ Senior China Strategist Zhoapeng analyses the significant changes on the way for China's monetary policy regime.
It will be a very significant change in the history of China monetary policy. Actually, I think it's the biggest change in 10 years since 2014.
But first, in 5 and 5 with ANZ. I'm Alex Tarrant, standing in for Bernard Hickey, who's on a midwinter break. Global markets start the week with concerns about the US Fed's rate cut timing after PMI data on Friday showed US activity grew at a faster pace in June. All eyes are on this Friday's core PCE data, the Fed's preferred inflation measure. ANZ senior rate strategist Jack Chambers says monthly core PCE is expected to grow 0.1% in May, which would be the lowest this year.
It's going to see the annual rate of inflation at its lowest level since 2021. In some ways, this is the data the Fed needs to see to be able to ease this year. We still think there hasn't been enough of a softening in either inflationary pressures or the economy for the Fed to be easing before September, but the recent data supports the idea that they will begin easing in Q3.
The Aussie dollar starts the week at 66.42 US cents. It was down 0.2% on Friday. The Kiwi was flat at 61.19 US cents. Number 2. Europe's June PMI showed softer than expected growth, with contraction in France linked to its snap election call. ANZ FX analyst Felix Ryan says EU political uncertainty had been a driver for the Swiss franc rising in recent weeks, ahead of Friday's surprise interest rate cut by the Swiss National Bank.
Certainly the sense reading through the statements there and also the comments from the SNB President Thomas Jordan, the Swiss franc strength that we'd seen in the past month on the back of European political concerns had really been a prime factor in the surprise rate cut. So to, I suppose, weaken the Swiss franc in order to prevent imported deflation into Switzerland.
Number 3. In Australia, the focus this week is the May CPI indicator on Wednesday. Here's Jack again.
We're expecting a slight lift, the annual rate of inflation in that, to go from 3.7 to 3.8%, which is in line with consensus. I would say that the caveat with this monthly indicator is that it's just an indicator. It's not the full CPI basket that we get with the quarterly data.
Number 4. Japan's annual CPI rose slightly to 2.8% in May, a touch below forecast. That was led by strength in energy and goods prices, while the services contribution was steady. Felix says that while the headline measure rose, core readings threw up some questions for the Bank of Japan.
CPI ex fresh food and energy, that eased for the third straight month in a row, really. So that's down from 2.4% in April to 2.1% now in May. So look, doesn't really necessarily, I think, on its own deny a bodge hike. There certainly seems that they want to move towards policy normalisation regardless, but it does suggest that there's a bit of, I suppose, fickleness in some of the underlying price pressures there.
Number 5. The yen slumped further on Friday, with the US dollar rising through the 159 level. Jack says that's due in part to the Bank of Japan delaying its decision on when to begin quantitative tightening.
I think in some ways, as long as you have the Bank of Japan sitting on the sidelines, creating uncertainty about the exact extent to which it's going to tighten policy in July, the yen is going to be under a bit of pressure just because we have the ongoing rate differentials with the US, and we're still kind of just in wait and see mode with the Bank of Japan to some degree.
Jack Chambers there. Now in our bonus deep dive interview, ANZ Senior China Strategist Zhoapeng analyses last week's announcement by the People's Bank of China that it is set to target only a short-term interest rate as part of a monetary policy shake-up.
Currently, there are many policy rates in the economy. We have 7-day reverse repo, 1-year medium-term lending facility, and standing lending facility, and also the relending rate. Currently, the PBOC hasn't identified a major rate as its interest rate target. It makes the system very complicated. So if the PBOC identify a short-term rate as the major target, I think the system will looks like the US Fed Fed after 2008 and or before 2008 and the RBA before 2020, the PBOC will manage liquidity to achieve its interest rate target. This is different from the current interest rate management. Currently, the PBOC manages interest rate from the very short end to the long-dated yield. So after the reform, I think the PBOC only focus on just one interest rate. The rest will be decided by the market. It will be a very significant change in the history of China monetary policy. Actually, I think it's the biggest change in 10 years since 2014.
When do you think this change can be made? Surely due to the significance of it, it is going to have to take some time.
I think it will take some time because the financial system is not ready for a big change yet. I mentioned that the PBOC will let the market to decide the interest rate in the future. But at this moment, the interest rate liberation hasn't been completed.
What does it say to us about how the PBOC wants to manage monetary policy in the future under this new regime?
I think going forward, the monetary policy by the PBOC will become more simple from the current system. Currently, the PBOC have very complicated tools in the toolbox. It's not very easy for the PBOC to manage 400 trillion financial system by this very complicated toolbox. I think going forward, the PBOC will just stick to the interest rate target and let the rest interest rates decided by the market maker. This will make the PBOC to concentrate the focus more on the short-term stability and the exchange rate so that it will give the more flexibility to the interest rate system in the economy. This will be good because this is a market-oriented reform that will help China economy in the future.
Zhoapeng Xing there. I'm Alex Tarrant, standing in for Bernard Hickey. That was 5 and 5 with ANZ for Monday, June the 24th. Catch you tomorrow with a look at how the RBA's hawkish turn last week contrasted with dovishness elsewhere.
This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.